Good morning, ladies and gentlemen. Thank you very much for joining us today. My name is Rocky Tong, and I'm the Director and Head of Policy Research for the Financial Services Development Council. Today, we are very happy to be launching a report, and the title of the report is Asset and Wealth Management in Hong Kong, Tax Recommendations Toward Further Development. So today, we are very happy to have Ms. Florence Yip, Senior Advisor of PwC, Mr. Darren Bowden, Partner of Tax in Hong Kong, Head of Alternative Investment in KPMG China, Mr. Rex Ho, who is a New Business Committee member of the FSDC. He is also the Asia Pacific Financial Services Tax Leader, Mainland China and Hong Kong, SAR Financial Services Tax Partner, Hong Kong Asset and Wealth Management Tax Leader of the PwC. Last but not the least, we have our very own Dr. King Au, who is the Executive Director of the FSDC running our operation. Today, as I mentioned earlier, the report is about asset and wealth management, but we are not going to talk about everything under the sun. We are focusing out, the core of this report is about how to advance the development of the areas that are less attended previously. And we wish to work on some operational matters that are worth our attention. And with a panel of very seasoned experts, we are going to cover them in the next 20 minutes or so. So I'll first pass the floor to Florence, after which we'll have some questions, preset questions designed by us. But I would encourage you to type in your questions in the Q&A box, which I'll be referring to specific panelists that you are seeing. After that, please do stay with us and tell us how you feel about our webinar today. Without further ado, Florence, the floor is yours.
Thank you, Rocky. Good morning, everyone. I'm very honored to have this opportunity to represent our working group to present our recommendations in the paper. I just want to quickly mention that our working group, other than the three of us here, Darren, Rex, and me, in fact, we are very honored to have participants from the financial services tax as specialists as well. They actually come from the banking, insurance, asset wealth and management, as well as the legal profession. In our deliberation of our recommendation, we take into account not only the, of course, solo asset and wealth management perspective, but we also take into account its direct or indirect impact from the banking and insurance sector as well. The whole objective of our report is to maintain Hong Kong as not only a leading international financial center, but also a very attractive and competitive asset and wealth management center in the region, as well as globally. So let me go to my presentation slide. Our recommendation actually focus on three main areas. The first one is to promote asset classes that are currently underdeveloped in Hong Kong by providing incentives, clarity, and operational efficiency. The second one is to attract institutional investors, which are currently not included in our tax incentive regime yet, by providing a level playing field in terms of tax to each type of such asset owners. Last but not least is to address the room for improvement in our unified profit tax exemption for funds. We will abbreviate it as UTE in this presentation, and the open-ended fund company regime. So in the interest of time, I shall summarize our recommendations from the perspective of these three objectives in the following presentation. The first asset class that we feel that we need to really focus on is the debt capital market. Hong Kong has been very fortunate and has had a very thriving and strong equity market. However, our debt capital market has developed at a much slower pace. And we observe that such situation or phenomenon has many factors. However, one important factor is the development of tax policies in Hong Kong in encouraging the development of debt capital market are falling behind compared to the fiscal policy launched by the government. So there is a gap between the fiscal policy and the tax policy in Hong Kong in relation to debt capital market. So there are two recommendations from our FSDC working group. First of all is to raise the awareness of current tax incentive relating to qualified debt instruments. In Hong Kong, we actually have a very well established tax concession regime for QDI. However, we need to more widely publicize it. The second recommendation in this area is the Hong Kong government should explore ways to facilitate the flow of international debt capital and to attract appropriate candidates and encourage a variety of investors with a view of diversifying the market. Next, please. So other than the previous two recommendations, we also analyze the potential growth or the current underdevelopment of our debt capital market in three particular sectors. The first one is fixed income sector in the debt capital market. We would recommend that legislation should be amended to clarify that interest income on bonds and debt investments should constitute a qualifying transaction for the purpose of UTE, and such that fixed income instrument can completely embrace the UTE exemption, like the equity products. The second one in relation to fixed income is issuers which are not financial institutions would need similar certainty or flexibilities in this respect to increase the number of bond issuance in Hong Kong. The second bucket of underdeveloped area of debt capital market is in relation to private credit, distressed debt, and non-performing loans, NPLs. We strongly believe that our UTE exemption scope should be extended to privately offered funds investing in distressed debt, non-performing loans, and credit strategies, because this is a huge booming trend globally as well as in the region. And Hong Kong, as a leading asset and wealth management sector, should not ignore this opportunity and pass it to the other markets in the region. The third bucket that is relation to debt capital market is on infrastructure funds. Now, infrastructure is a very trendy area given that the government has proposed, for example, the North Metropolis project and also the Lantau Tomorrow Vision project. And also infrastructure funds plays a big role in the carbon net zero or carbon sustainability neutrality goal of the government. So we believe that there are plenty of rooms for the UTE tax exemption to expand the scope of infrastructure assets qualifying for UTE. Next, please. The next categories of recommendation is in relation to attracting more different types of institutional investors to Hong Kong. Next, please. Okay, currently our UTE exemption does only cover one type of asset owner called sovereign wealth fund. That's a clear definition of sovereign wealth fund in our UTE exemption law. However, pension funds, endowment funds, and family offices are not currently clearly exempt in the UTE exemption law. We believe that pension funds, endowment funds, and family office play a pivotal role in bringing capital as well as talent to Hong Kong. So we strongly believe that all these three types of asset owners or institutional investors should be considered to be added to our exemption regime. Next, please. And other than the previous three types of investors, we also believe that insurance companies we need to pay special attention to insurance companies. Now, insurance companies currently themselves are paying tax in Hong Kong, but there's a special feature of insurance company because they do collect insurance premiums, okay? And also, many insurance groups and multinational insurance groups have set up their regional office in Hong Kong. So in relation to insurance sector, we have two specific recommendations. The first is a tax exemption on the investment income of Hong Kong insurers if their insurance fund assets are managed in Hong Kong. Because in the absence of such exemption, currently, such asset management activities are not taking place in Hong Kong. In fact, they are taking place outside of Hong Kong. So it would be unfortunate that we are actually voluntarily giving away a business opportunity that should have taken place in Hong Kong. The second recommendation is to address the issues faced by insurance groups with Hong Kong parent company or regional holding companies if they manage the assets of their overseas insurance group entities in Hong Kong, because the purpose of having a holding company in Hong Kong or regional headquarters in Hong Kong is not only to have the regional office, headcounts, but also if they can play the treasury management role, we want such activities to take place in Hong Kong. However, our UTE exemption currently have a deeming provision, actually would effectively tax such income. So effectively, those treasury management functions would unlikely be taken place in Hong Kong. So we, again, giving away a good business opportunity to other markets in the world. The second type of instrument investor is what we call employee investment vehicles. We recommend that tax policy and legislative changes should be made in order to extend the UTE tax exemption to include genuine employee investment vehicles. So we can attract multinational companies to come to Hong Kong to manage their employee investment vehicle as well. Last but not least is a very unique concept called co-investment vehicles in the asset and fund management world. This is rather technical, so I won't delve into the detail, but the essence is co-investment vehicles, actually they are also an investor. However, currently they are barred from enjoying the UTE. And this would create enormous difficulties for fund managers to make investments or to successfully close their investments. Next, please. So the last area that our recommendation would cover is the various areas for improvement in our UTE regime and OFC regime, please. We have 6 recommendations in this regard. Now, our Hong Kong government has actually done a good job. Since 2006, we have launched our first generation of investment for privately offered funds. And gradually, with the development of time, the movement, we have actually come up with a unified fund tax exemption in 2019. However, this 2019 regime does have some deficiencies. Currently, we are hearing comments from the players and investors. So we believe that it's opportune time for us to revisit this UTE and OFC regime. The first one is to expand the scope of funds able to fall within the exemption, including not only the 3 types of investment vehicle, the pension funds, the endowment funds, and family office. Okay, we also would recommend the scope of funds to include fund of one, because fund of one is also an investment fund, and remove the existing deeming provisions, which would cause difficulty to, in particular, family office as well as insurance companies. Expand the scope of permitted asset class, particular private investment that can fall within the exemption, and streamline the procedures for issuance of certificates of resident status, in particular for special purpose vehicles of an investment fund managed from Hong Kong. and also remove or refine the restriction on short-term assets in the 2019 UTE exemption law. And last but not least is to provide an exemption of Hong Kong stamp duty on the transfer of stocks in open-end fund company. So here I conclude my presentation and I will pass it back to Rocky.
Thank you very much, Florence. We received a couple of comments from the audience saying that they couldn't see the PowerPoint, but it is fine. We'll be posting it online afterwards. Please rest assured that the report is also available to the public and you can check it out online. So let's move on to the panel session. And my first question is directed to our Executive Director, Dr. King Ngau. Hong Kong has been very well in various financial services industry, but particularly our asset and wealth management industry has been a very key area of development. Perhaps you can share with us why we are, as a whole, considering that this is an important area for Hong Kong to further develop the AWM industry.
Thank you, Rocky, for this very important question, because in my view, a successful international financial center would need to have a vibrant capital market for capital formation, as well as a strong asset and wealth management industry for wealth preservation and creation. Lacking either one is just a financial center in name only. So you look at Hong Kong first, the asset management industry, based on the SFC biannual survey report published in 2021, the asset under management for our industry stood at $4.5 trillion at the end of 2020. And that represents an increase of 21% year on year in 2020. But in addition to asset under management, talents employed in the industry has also grown significantly. Based on the same report, we had over 48,000 industry professionals in 2020. And there were close to 2,000 companies licensed same time. And that also represents a very significant increase of close to 80% since 2014. In the recent budget speech, the government has also added professionals in compliance in asset management to the talent list of Hong Kong under the Quality Migrant Admission Scheme. Such addition could bring further boost to the industry and related sectors. So now coming back to your question, with Hong Kong being a super connector, our asset and wealth management industry plays a very strategic role of providing a conduit for investment flows between mainland China and the world. That means we have to continue enhancing our product capabilities and market infrastructure to keep up with global investor demands. So enhancing our taxation policy is an effective means of developing our industry, because not all taxes are created equal. So Florence has already succinctly highlighted our key recommendations just now.
Thank you very much, King. I actually got quite a bit, from your answer. So we can't just be an IFC in name only by not having the AWM industry, but also only the capital formation, being a capital formation center. Then you also mentioned how we value not only the money or the assets managed here in Hong Kong, but also the talent. Those are very important functions and factors contributing to our success as an international financial center. Florence, I'm going to come back to you. The tax landscape in Asia and globally has been evolving very quickly, in the last few years, especially. Perhaps you can share with us some of the recent and emerging tax-related trends and issues within the AWM sector.
Right. Okay. From a global level, I think many of you are aware of something called BEPS 2.0. OECD's BEPS 2.0 is actually undergoing a rolling consultation phase. It actually launches its fifth consultation just early this month. On Pillar 1, regarding regulated financial services exclusion. So there is a proposition to exclude financial services from Pillar 1 of BEPS 2.0.
Right.
However, the consultation paper suggests 7 types of regulated financial institutions, including depository, investment, insurance institutions, and asset manager. The related definition contains 3 requirements, which are licensing, regulatory capital, and activities. However, there are significant aspects of these rules remain completely unagreed or have been left open. So, however, many major asset and wealth management markets continue to review and refine their fiscal policy and tax policies to attract capital and asset management talents. For example, Singapore has just last month in April updated its incentive scheme to attract family offices and asset managers serving family office to Singapore. And Japan's tax reform last year proposed to tax carry interest earned by fund managers as capital gains arising from sale of shares. Now, this is very, very, I would say, encouraging, because we all know that, for example, Japan is a very cautious in terms of its tax policies, but is stating that carry interest earned by fund managers are capital gains arising from sale of shares. Now, in Hong Kong, the government has launched this carry interest concession regime, and the law has been passed. However, the implementation rules are still under discussion. So we sincerely hope that our government could take reference from other markets and act accordingly and come up with implementation rules that are practical and feasible.
Thank you. Thank you very much, Florence. You mentioned a lot of very valuable findings that we have highlighted in our report. Not only BEPS 2.0, but also areas in relation to how Hong Kong should be doing more in terms of tax policies. Very glad to report that, within the government, the Secretary for Financial Services and the Treasury is actually leading a working group to tackle issues rising from the BEPS 2.0. So hopefully the business leaders and tax experts involved will be coming up with a proper guidance and solutions to this. You also highlighted that the incentive schemes in various jurisdictions to attract talent and businesses and AUM flowing there. Rex, you previously led our working group on family office, the paper which was published back in July 2020. Yeah. I think the next question must be related to you. So the paper proposed this paper that we are releasing today proposed measures to promote underdeveloped asset classes in Hong Kong with a focus on the debt capital market. How does the debt capital market perform recently in Hong Kong, and how important it is for us to develop this market for the AWM industry?
Okay, thank you, Rocky. I think the debt market is very, very important for Hong Kong. Say, as Foreign Secretary talked about, say, in her presentation, I think everyone actually knows the Hong Kong always is announced for its equity market. Right, no doubt, the Hong Kong equity market is always on top of the league table in terms of the new issuance every year. But if you look at the debt market, the development of the Hong Kong debt market is definitely at a much slower pace. Right, to put it into context, if you look at some of the statistics provided by the Bank of International Settlement, the Hong Kong outstanding debt instrument value is only 8% of the UK value and 1% of the US value. So basically, this is a big gap. And if you compare the equity market, the global equity market and the debt market, in fact, the global debt market is bigger than the global equity market, right? So there, we can actually see there's a lot of opportunity for Hong Kong to capture on the debt market. Say, be it, this is the public debt market, or the fast-growing private credit market. the infrastructure financing that Florence mentioned about. And also in recent years, the Hong Kong government has been promoting green finance, sustainable financing. This is all related to our debt market. And of course, we need government policy to support that. And then we're basically very glad to see the government has different fiscal policy introduced in the last few years to support that market. For example, giving subsidy for bond issuance, et cetera, et cetera. But as our paper alluded to, I think our tax policy also needs to catch up. So interestingly, when we actually talk to the private credit industry player, basically one of the association has done a survey, and 60% of the respondents basically say if the Hong Kong tax policy can be changed or refined to allow more certainty for the credit market, private credit market, they will increase, or they will definitely consider to establish or expand their presence in Hong Kong. So therefore, we actually see the debt market has a lot of opportunity. So that's why I think we actually need the tax policy to support as well.
Thank you very much, Rex. I think it's very comprehensive. It's not only that we are lagging behind some of the key markets. In Hong Kong. Hong Kong always ranks pretty up high as a global financial center. We are neck and neck with the likes of London and New York. But in terms of the debt market, we are only representing 8% and 1% of them respectively. So there's a lot of room for us to grow.
Rocky, may I interject? Because that's a new latest development. Whilst we are in Hong Kong still considering or debating whether we should change policies to encourage private credit. In fact, in the GBA area, in the Greater Bay Area, the Guangzhou and Shenzhen government have issued new rules to promote not only funds, including private funds in the equity sector, but also debt sector, which is called 投貸基金, 投貸基金. So whilst GBA is already moving ahead, so what are we doing in Hong Kong? I think so this is something for us to consider carefully. Thank you.
Yeah, absolutely. I think we need to not only issue the paper, but to work with relevant departments on updating it. I was just saying that there are a lot of areas that we should work on, but private credit, the infrastructure financing, sustainable financing, those kind of areas are things that we have to work on. Rex, you also mentioned that industry players were to expand here in Hong Kong if some of the issues were to be resolved. Darren, I'm coming to you because you are the expert, also like the others on the panel, and you are interacting with a lot of people within the debt capital market. So what are some challenges that your clients have been telling you in relation to tax?
Thanks, Rocky. As Florence and Rex were just alluding to, Hong Kong at the moment is seen as Asia's leading asset management and private equity hub. There's no doubt about that, but Hong Kong does clearly face some challenges, and also competition from our main competitor, which is that of Singapore. Over the years, certainly Florence, Rex and I, and some others have worked really hard to modernise our funds exemption, and we've come a long way. As Florence will certainly know, we've been able to successfully get through some really important reforms to our funds exemption regime. So our funds exemption regime at the moment, I would describe as pretty good. It's very competitive, but it's not perfect. And for one aspect in particular, which Rex has just touched on, private credit and debt market, which is really important for Hong Kong's future. We know the growth that our clients are seeing in this particular strategy. So private credit and debt, as Florence was also saying, is booming. We're seeing an increasing number of private credit and debt funds being raised as our larger fund clients are expanding into this particular niche market. And they play a really important role in the market. So they're not there competing with traditional lenders, being the banks. They provide alternative sources of financing to our clients. and to corporates and individuals out there in the market. Unfortunately, however, when we look at our funds exemption, as we've just been mentioning, it doesn't cater to the private credit and debt market as well as what it should do. And again, unfortunately, I should say this, when we look at our main competitor, Singapore's funds regime and funds exemption works almost in the same way as Hong Kong's, except for private credit and debt, it's much clearer. And that activity is covered by their exemption. But at the moment, it's not covered by ours. So we've been working really hard over the last number of years, and we continue to advocate and lobby on this area that we need to make a small amendment to our exemption to make sure that private credit and debt is covered, because for all intents and purposes, and I'll finish on this, private and credit and debt operates in the same way as private equity. And they approach the market in exactly the same way. So we just want to make sure that private credit and debt is covered by our funds exemption.
Fantastic. Thank you very much, Darren. I think the challenges we face is to extract or to ride on the rise of some rising trends. I think FSDC has been doing just that for the past years. We talk about topics that perhaps the public sector was not thinking about just yet, but then we did try to address them at the forefront. And so hopefully we can, like Darren mentioned, continue to contribute to a bigger pie instead of forcing a certain sector to compete with the existing sector. It's not our idea to do so, but we are trying to bake a bigger pie, so to speak. All right.
And Rocky, can I just have one for
Please do.
And just on that, because I did say that Hong Kong at the moment, I still think is Asia's leading asset management private equity hub. And I think if we're able to get this, what we will describe as a minor amendment to our funds exemption to cater private credit and debt, I think that just ensures that we retain that status going forward.
Yes, this is absolutely our aim and members of the FSDC's aim. Florence, coming back to you, the government is committed to furthering investment in infrastructure, as you mentioned in your presentation, to enhance Hong Kong's competitiveness with quite a few projects. How can our tax rules further facilitate the development of infrastructure sector in your view?
Okay, yeah, thank you, Rocky. In fact, I would say all along infrastructure has been as an asset class, has been underdeveloped in Hong Kong. Rarely you would hear people say, oh, I'm launching an infrastructure investment fund. Of course, there are a number of such funds in the market, but they are not as popular as like equity. Okay, so now, given the importance of infrastructure, and as I mentioned, that with carbon neutrality as a global objective, so how to make infrastructure carbon neutral or carbon net zero is you need a lot of funding. So in that regard, investment fund should be and also be considered as an effective platform for fundraising to direct capital, in particular from the private sector, to infrastructure projects that need funding, not only in Hong Kong, but also in the region. So this is something I think Hong Kong should play an active role to seek to be an infrastructure hub in the region, or even one step further is green and sustainable infrastructure investment fund hub and also financing hub. Now, I'm very delighted to hear that not only in the government and the Finance Secretary's budget in February announcing about the infrastructure projects in North Metropolis, but also the announcement of the Hong Kong Mortgage Corporation would be responsible to launch this infrastructure securitization financing pilot scheme. So that means infrastructure is now on the radar screen. But in terms of taxation policies, we have noted in our report that the definition of infrastructure in our Unified Tax Exemption law is still rather limited and covers conventional infrastructure. In our report, you can see from the appendix that we also compare definition and scope of infrastructure in other markets, in other jurisdictions, including those from the EU, OECD, mainland China, US, UK, etc. The definitions would include some more modern terminology or sectors such as new infrastructure, green infrastructure, sustainable infrastructure, etc. So I think this is something that we would recommend the government to seriously consider, because if our definition of infrastructure is still limited to the conventional ones, then probably this would also limit the potential of growth of or development of infrastructure investment fund in Hong Kong. The next issue is regarding, it's rather technical, incidental components of infrastructure project or assets such as offices, employee, dormitories, etc. Of an infrastructure project. We recommend that certain space should be given to such incidental real estate portion of infrastructure, so that they could qualify as infrastructure asset class and be exempt under the UTE as well. The next recommendation in relation to infrastructure is we have observed many infrastructure investment funds in the Belt and Road area. In fact, they operate as such so that the infrastructure fund itself would be the one who would develop the infrastructure, as opposed to investing in a company, that company develop the infrastructure. So in our law, we particularly prohibit or exclude such a scenario from enjoying the UTE exemption. So we recommend the government to reconsider that. And last but not least, as I said, Hong Kong has introduced the carry interest concession regime. We hope that in due course, when infrastructure is reviewed by the government in its tax policy, qualified infrastructure fund managers would also benefit from the carry interest concession. So, yeah.
Fantastic. Thank you very much. So is the definition is more, it has to be expanded. The inclusion of the types of investor have to be reconsidered. And I think it's really not to bar or be too restrictive in terms of what type of investors we are drawing in, but rather, like both of those who are directing someone else to manage their money, and as well as those, who directly manage their own money. So this is very important. Darren, so Florence has mentioned about how we should expand the scope and draw in more institutional investors to Hong Kong. Perhaps you can share with us why this is important, and what role does the proposed enhanced tax regime can play in the context of enhancing our competitiveness on that front?
Yeah, well, Rocky, first up, I think institutional investors play a really important role in the asset management market here in Asia, and indeed globally. And institutional investors do a number of things, but importantly, they allocate capital, and much needed capital, both to other funds and providing capital investments to other GPs who are investing that and deploying their capital in the region. But also the larger institutional investors are also doing direct investing. So they are out there sourcing investments and managing investments in the same way that an asset manager does as well. And what we want to be doing is promoting Hong Kong as the leading hub in Asia for those large institutional investors to come and set up their regional headquarters in Hong Kong and start managing their investments from Hong Kong and deploying capital from Hong Kong. So it's a really important part of the asset management sector. And as Florence went through before and explained it quite well, our funds, rules and exemptions work really well. But there are some refinements. We just want to make it even more clearer and cleaner that these big institutional investors, when they come to Hong Kong and they're setting up substantive operations in Hong Kong, they're employing a lot of people, they're contributing to the economic development of Hong Kong. And we just want to make sure that in doing that, they're not exposing their investments, which are made all over Asia, not just in Hong Kong or in China, to any additional tax for their investors. So there is a lot at stake, and again, we continue to work very hard to just get these refinements to our funds rules.
Thank you. Thank you so much, Darren. I think this is along the same line that we propose relevant tax recommendations in our other papers. So having the institutional investors being here, they will be able to, as you rightly mentioned, allocate capital to other funds, be it GP, and also they do direct investing. And really, like in some of our recommendations here, we are not trying to ask the government to have another tax concessions or another type of concessions. I mean, some of the recommendations we covered, yes, but others, we are really just demanding for some cleaner and clearer definitions as set out in the tax rules. So hopefully we will be able to move the needle on that front. Rads, I'm coming to you. Recently, the Hong Kong government proposed profits tax exemption for family-owned investment holding vehicles managed by SFO or single-family offices. Like I mentioned, you chaired our working group for the paper published back in July 2020. So this is very relevant. And thankfully, the concession is expected to come into effect in this fiscal year. This is also mentioned in our report. So perhaps you can share with us some high-level implications of that, and how is it going to benefit us?
Yeah, definitely, Rocky. And I think I'm very, very glad to see the government has actually taken action, take on board our recommendation in the earlier paper to improve the tax policy on family-owned investment vehicle. So as say Darren talked about, I think family office is also one of the institutional investor. And in fact, this is a very fast growing and very important class of the asset owner, which Hong Kong should try to attract. Okay. Again, to put in context, some of the statistics shows the total AUM, asset under management, by family office globally account for 8% of the total AUM of the global asset wealth management industry. So basically the wealth or the asset managed by family office, in fact, is huge. Okay. And APAC, if we actually look at APAC, right, we have the fastest growing number of billionaire in the world. Okay. But family office is always a relatively new concept in this part of the world as compared with Europe, as compared with US. So I think we see a lot of opportunity for Hong Kong to attract the ultra high net worth people to come to Hong Kong, set up family office in Hong Kong, and have their asset managed in Hong Kong. Okay, we estimate basically is if Hong Kong can capture 30% of the newly set up family office. Okay, say if a ultra high net worth want to set up a family office in APAC, if we can attract this 30% new setup, it can bring around 50 billion US dollar AUM to Hong Kong every year. And that $50 US dollar AUM translate to an economic benefit of 600 million US dollar spending, say in terms of creating job, in terms of engaging service provider, engaging bank. So they need to spend to manage the asset, 600 million US dollar per year. So this is not a small number, and this is definitely is a economic benefit that we want, Hong Kong want to actually capture. So as I mentioned, I'm very glad to see the government has taken on board our recommendation to take action to right now give tax concession for investment vehicle managed by single family office. I think that tax certainty is super important. On one hand, it can actually attract new family office to come to Hong Kong, establish in Hong Kong. And on the other hand, is to keep our existing family office. Hong Kong also have a lot of the wealthy family has already set in Hong Kong. And it's very important to keep them in Hong Kong, not to move somewhere else. Now, Hong Kong, we have a very good ecosystem, right? But we also face a lot of competition in neighboring countries, neighboring jurisdiction. So if we don't say keep up to pace, then we will actually lose our business. So I'm actually very glad we take action, and hopefully we can actually retain all these actually existing family in Hong Kong to continue to operate in Hong Kong, manage the asset in Hong Kong.
Yeah.
Thank you.
Rocky, can I just have a comment on,
Yeah.
following on from what Rex is saying, and the proposed framework that we've been working on for the family office regime, Rex, is pretty good. And I was talking before about the competition that Hong Kong has with Singapore.
Yeah.
And obviously in the family office market, Singapore is out there also trying to put forward itself as being a family office hub. But when you compare Hong Kong's proposed framework with Singapore, I think Hong Kong's is better than Singapore's.
Yeah, definitely. If not better, at least it's at par with Singapore, right? Yeah, on par. So I think this is a very good news. Yeah.
Fantastic. Good to hear from the real experts saying that we are at least on par, if not better. And on that front, I think, Rex, you mentioned a very good point. We are not discriminating the existing family offices here. So, the tax concession proposed by the government is going to put everybody on a level playing field.
Correct.
A term that we always use in all our papers, saying that, we want to ensure that, be it the existing as well as the newcomers, our families or other institutions are going to be treated the same. So hopefully we are going to see the effective date moving closer and then sooner.
Yeah.
King, this is the last prepared question. I would like you to highlight some of the key initiatives that we are doing in relation to AUM and the other things, because we are concurrently working on quite a few projects, but you will be able to walk us through some of those.
Sure. First of all, I want to thank the panel again for all this very insightful sharing. Having done marketing for so long, I'm probably indoctrinated, because I would like to think that the recommendations are tax incentives rather than tax concessions. Because I can share with you some examples. Like back in the old days, I can't remember how long now, Florence can remind me, when we introduced this offshore tax fund exemption, right? And as a result of that, we now probably the region's largest hedge fund center, right? And private equity, venture capitals hub as well. So I think, we are proposing a similar kind of tax incentives, right? To further expand our asset and wealth management industry. So on that note, I want to share with everyone the kind of projects that we've been working on, focusing on market infrastructure as well as product innovation. In terms of market infrastructure, we've been looking at ways to enhance liquidity of our market, both mainly in the equity space. But we are also expanding our study to look at the capital formation ecosystem in Hong Kong, covering not just equity, but also bonds. So the tax incentives that is recommended here would play a key role in that. And also, we're looking at reviewing the suitability and AML approach for the asset and wealth management industry. And in terms of product innovation, perhaps also straddling market infrastructure, would be a paper on data hub for GBA. How we can actually expand our super connector role into the digital economy, connecting data in China, mainland China, with Hong Kong and the rest of the world. Last but not least, we've just started a new working group to work on carbon market opportunities, because we've been talking about ESG for so long. I think this is time to really put words into action. That's what we're trying to do. And that's also echoed by the cross-agency steering group on ESG as well.
Thank you. Thank you so much, King, for taking this opportunity to share with the audience some of the key projects that we're working on. Rest assured that we are not going to forget about all the recommendations that we put forward, but we are devoting equal share of resources to new projects that we are trying to move forward. So I received quite a few questions, and I would like to start with one that I received from Rain Chow. How BEPS 2.0 Pillar 2 may generally impact the AWM industry in Hong Kong. Take care. Florence, maybe?
Yeah, maybe I have a go first.
Sure.
Okay. Now, first of all, for BEPS 2.0, actually there is a entry point. Entry point is you need to meet certain threshold before you are welcome to this regime. Okay. So one of the threshold is 750 million euro. So I think on revenue. So I think first of all, the group, the operator, the AWM player need to be that big. Now, however, even if one does not meet the threshold, does not mean that, okay, then it does not concern a fund manager. Because if the fund manager invests in a portfolio company or in a pre-IPO company or in any target, and if the target actually hits the BEPS 2.0 threshold, or it's part of a group companies that hit the BEPS 2.0, then there could be ramification to that fund manager in its estimation of, for example, effective tax rate, cash flow, and also certainty. Because in the past, the financial forecast, including cash flow forecast of the target company, might be projected using the traditional, conventional pre-BEPS 2.0 rules. However, with the BEPS 2.0 rules, in the perfect case, there is certainty, so that at least you know what the rules would result in, so you can determine the financial consequences. However, as I mentioned in my presentation, various rules of BEPS 2.0 are still under consultation, under debate, and there are lots of disagreements on the definition, etc. So how it could be implemented could be a big question mark. And so it would give rise to the uncertainty or the difficulty in forecasting. Right. So I think this is my key observation. Maybe I would ask my fellow panel members if you have anything to add. I
would agree. So I think the only thing I would add is most funds on the fund side will be carved out, but there will be some funds, especially funds from that are established by corporates, as you were saying before, Florence, insurance companies, they won't be carved out. But on the management side, yeah, I think it's going to be a real mess, isn't it, for the first couple of years when it comes to the implementation and the enforcement of these rules, and to see how it does work out, because you will need to make sure that you are at least paying an effective tax rate of 15% in each of the countries in which you're operating. But there's a lot to play out, and there still is a lot of uncertainty.
Sounds like uncertainty is the word, and then the only certainty that we have is going to be uncertain. So that would be the question from Wayne, and then there's a question from Stuart, whom I believe is a very seasoned expert in this field himself. It has been announced that China is going to make further changes to their mutual fund industry to make it more competitive. How can Hong Kong play a part in that? Take care. Ladies first.
Okay. All right. Okay. Now, it is hi, Stuart. long time no see. Thank you for joining this webinar. I would say I think we are very pleased to see, China, despite all these challenges, what's happening in the past few years globally, China is still ongoing to expand and reform its asset and wealth management sector. I think Hong Kong, including mutual fund industry, but of course the private fund part actually has also been undergoing, good, I would say, pace of development as well. I would say Hong Kong being a key fund center, what we can do, I think if we look at the mutual fund recognition regime at the moment, it's been kind of, how to put it, a little bit, the products that Hong Kong can offer up to the north, the investor from the north, seems to be limited. Or relatively smaller in number. So I think in order to, and don't forget, I would say, RMB internationalization is one of the key objectives of the China government, and how Hong Kong can enhance the internationalization of RMB. One way is to create fund products that could be accepted by regulators on both Hong Kong and the mainland, so they can be purchased by investors from the other side. Okay, so in Hong Kong, we do have a great pool of fund management talents. We do have the skill set, and we do cover asset class, more asset class. But of course, we need to ensure investor protection and also regulatory risk. And also, risk management is very important. So I think I would encourage Stuart and your friends in the community to, I would say, come up with different kind of products and test the water and see what can be offered. So, for example, what I'm going back to the infrastructure asset class. Last summer, China for groundbreaking development is in the summer in June, 9 infrastructure REITs were launched in China. And why is groundbreaking? Because there's no infrastructure REITs at all in China before. Now, they have been oversubscribed, and of course, and they are the very preferred by, I would say, not only retail investors, but institutional investors like retirement fund. Now, at the moment, such China infra REITs could only be accessed by mainland China investors if they are qualified foreign investors, QFI status. Now, previously it's called QFII, but they changed the regime a little bit, and now it's called QFI. However, not many institutions or people are QFI holder. So at the moment, China infra REITs are not widely accessible to the so-called international market or the Hong Kong market. So I'm thinking that is it possible that given Hong Kong is also we're going to have quite a number of infrastructure projects. And also we try to promote Hong Kong being infrastructure investment fund hub. Can also Hong Kong offer something like infrastructure investment fund product, be in the REITs vehicle or another kind of vehicle? We can think about it. However, once we have this, because good quality infrastructure investment products would provide good long-term recurrent income to the investors. And we could offer that, and then hopefully that would help international monies going to invest into China and vice versa if we put the infrastructure investment fund products under either the mutual fund recognition regime or the Connect scheme. Of course, this is not an easy road, but I think there would be a market demand for such financial products.
King, can I go to you, because you have 30 odd years of experience with the asset and wealth management industry.
Shows my age. Yes, I echo what Florence just said. In fact, last April, we published a paper on revitalizing REITs in Hong Kong, coinciding with the launch of the REITs in China, mainland China. Going back to Stuart's question, I think the encouraging news is that we will have ETF connection, and Wealth Management Connect is also another excellent channel for us to introduce non-mainland China products into the mainland. What I think we should really look at is mutual licensing recognition within GBA. How further facilitate the development of Wealth Management Connect, I think.
Good. Any other? Okay, so I guess the expanding the access to the investors, including the inclusion of more products in the Connect schemes would be something to begin with, and I think this is going to we have to work with relevant stakeholders on that front. Mark Saunders is asking us a question. While Darren is suggesting a meaningful yet relatively easy to amend proposal, which is very sensible, could the panel provide details of the process moving forward for getting such amendments implemented and provide us with an estimate of timeline?
Yeah, I'll kick it off. Okay, the process really involves us continuing to engage with the government. And over the last few years, in particular, Rex, Florence and myself have worked very closely with the government and also the industry on a number of these reform areas. And I think that's what we'll continue to do. The changes that we've been sort of touching on today, in some respects are either interpretational differences, or it's a relatively minor amendment to the funds exemption rules. I think going forward, given all the competition that we see out there, and everyone wants to ensure that Hong Kong retains its status as not just Asia's leading asset management hub, but also as a global financial centre, I sense it's going to be easier to get some agreement on some of these refinements going forward and get these changes through. And more importantly, doing so in such a way that we ensure that there is no abuse to the arrangement and there's just a positive contribution to Hong Kong going forward. I would hope, just finishing, that maybe, Florence, we can get these changes through next year.
Well, I would hope. I mean, we are all standby 24 hours, 7 days a week, right? But we hope that before the LegCo go to summer recess, we could see, for example, the successful implementation of our carry interest concessions, taking into account of the industry feedback. Okay, that's one. And then the other is the IRD could actually issue departmental interpretation and practice notes to clarify the uncertain areas which we have highlighted in our report. That could also be a solution. Of course, I think what is important going in the long term is for the government and the stakeholder to understand the industry, because there are different segments in the industry. Although fund industry seems to be just one industry, but there are different segments in the ecosystem. And we would like to have a review of our tax policies to encourage the healthy growth and development of different parts of the ecosystem. So this is
yeah, and maybe just to add to that again, I think everyone, certainly everyone here, and certainly our clients, the people that we engage with, all understand the important role that asset management does play for Hong Kong, and the future importance of that, because all of the growth that we're seeing is coming from the asset management sector, and that's only ever going to increase because we're seeing larger allocations towards asset management going forward. So it's really important for Hong Kong.
Yeah, I definitely actually hope. Say basically, there's no reason not to do that.
Yeah.
Right. Say as long as we can address some of the concern about say our bills, then I think the proposal that we actually put down in the paper are definitely actually worth say taking on board and implement. As I mentioned, I think I see no reason why we don't do that. And for the benefit of Hong Kong,
and they're very sensible proposals.
Correct.
Yeah,
yes, yeah.
I can attest to the very fact that the panel, all the panelists don't really sleep, and they do respond to our emails 24/7. So thank you very much for sharing your insights with us and sharing your ideas with us. For those of you in the audience, please do stay with us as we are going to have the polling up, and please do give us your feedback, and we'll try to improve our next webinars. And yeah, thank you very much for joining us today.